In this video, we're going to talk about Vinco Ventures trading under the ticker symbol BBIG. At the moment, there's a lot of volatilities coming out of the financial market, and we have to be careful about which stocks to buy and which stocks to sell. This video is going to cover the recent price action momentums and the technicals of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $3.10 before closing the trading day at around $3.18. We should watch out the $3 level nearby because it was tested 4 times before, which is a very significant support level to watch out for. Over the past 30 days, the trend of the stock has been bullish because each low and high has been higher than the previous one. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish because the stock has been under a huge amount of selling pressure from the institutional investors. When we look at the price trends overall, it's been accelerating on the bullish recovery, which means that the short sellers are getting squeezed, and this is an excellent news for the stock in particular and for shareholders who are long the stock in general. The trading volume of Vinco Ventures has recently been 17 million shares versus an average volume of 36 million shares. Over the previous 52-week period, its price fluctuated between $1.95 and $12.49. The market cap of Vinco Ventures is currently at $434 million versus an enterprise value of $362 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus all the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, just like the market cap, it remains an estimated value of the market every single time it publishes its financial statements. So it's less reactive than the market cap and often more lenient for most companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it is assumed that it may have a better management, stronger brand recognition, and bigger online following. It is basically what makes this company unique, in particular compared to other rivals in the same sector. It's not a tangible asset that companies can use, but it's often the reason why some companies can be perceived to be trading at a discount, because the market cap is lower than the enterprise value, because the enterprise value is less reactive to the market cap in very volatile situations. If the company goes to liquidation, the goodwill is no longer, and we gotta distribute what's left with the bondholders and staring at a balance sheet that'll be a lot less attractive compared to what we have at the moment. When we compare the current price to its historical price fluctuations, the stock is 26% higher than the 1-month low, 47% higher than the 3-month low, and 63% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 137%, versus a historical volatility of 173%. The put-call volume ratio is currently at 0.24. It is normal for most stocks to own a higher put option volume than what they truly deserve because many institutional buyers hedge their long positions by buying put options. The most recent volume of options traded has been 90,000 contracts in a day, compared to the 30-day average volume of 154,000. In terms of open interest, the most recent volume of open interest has been 1 million contracts compared to the 30-day average of 910,000 contracts. In terms of its shareholder structure, institutional shareholders own about 13% of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It is relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be an investment and not just a trade. This is obviously subject to a lot of exceptions since many great titles are still held by retail traders and not institutional ones, but that's the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there is significant short interest going on, and that can be a telltale sign of a shorting operation. The short volume is currently 31% of the total float, which is very, very significant, and 52% of dark pool transactions. Overall, my opinion on Vinco Ventures is bullish because the stock seems to be at a reasonable level with upward momentum. Despite the very significant volume of short interest, the maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are very close to where the stock is at the moment. I would recommend to go in the stock right now at 40% of the allocation so that 1. You have enough room to buy for later purchases, but 2. You have enough shares at the moment to benefit from the very favorable price action. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months. especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.